Okay guys, welcome to Module 1. In this module, our expert will give us a general overview of bookkeeping. So, get ready to take some notes and let's jump right in.
Not all business owners went to business school. In fact, there are a lot of entrepreneurs who just simply had a game-changing idea and made it work. If you've just entered the business world, you'll probably agree that handling financial matters may seem to be the most daunting out there. But fear not. This course will show you the importance of bookkeeping and how to choose the one that will best suit your business needs. Bookkeeping is a vital component of any business. To prevent problems from happening in the future, proper execution is crucial from the outset. Making bookkeeping your top priority is the pivotal way to maximize efficiency and give your business its breakthrough. The first thing to point out when you're going to do your own bookkeeping is the difference between bookkeeping and accounting. If you're unfamiliar with these practices, there's no surprise that you might interchange them. In fact, even some accomplished business people will still fail to distinguish the discrepancy between the two. So before you even get to know how bookkeeping works, it's important to understand first what bookkeeping actually means. Bookkeeping is the process of recording business transactions and organizing financial documents. On the other hand, accounting uses the data extracted from bookkeeping records to understand a company's financial health and progress. In short, a bookkeeper tracks finances, while an accountant examines them. Bookkeeping is less daunting than it sounds, knowing that it doesn't require the same analytical skill as accountancy. In fact, it can be easy, as long as you've committed to straightening things out. Whether you decide to handle it yourself or let someone else take care of it, you should understand how the process works. When doing bookkeeping, there are 3 key things that you need to do. 1. Keep track of your finances. When bookkeeping for your small business, you can break down your finances into 4 categories: profits, expenses, cycle inventories, and liabilities. Profits are revenue generated after accounting all expenses. Profits can be divided into cash or credit sales, depending on whether the customer pays you at the time of purchase or when you send them the bill. Expenses are the exact opposite of profits. It's costs incurred in a company's effort to generate revenue. It can be actual cash payments, an expired portion of an asset, or amount deducted from earnings. Expenses can be divided into non-recurring or recurring expenses. Non-recurring refers to one-time unexpected charges, whereas recurring refers to the payments that repeat on a certain period, such as bills. Cycle inventory is a process of keeping track of inventories by performing inventory counts on a regular basis instead of annual or quarterly periods. If your business sells a product, your inventory cycle should record product purchases and sales, allowing you to see your backlog at all times. Data gathered from cycle inventories are essential parts of companies' total assets. Liabilities are your company's obligations, such as loans, mortgages, bonds, and more. Liabilities are different from expenses, and they should be organized accordingly. 2. Organize your accounts. Having well-organized accounts make accounting easier and allow your finances to be more accessible. If you're unsure how to organize your accounts and won't be doing the accounting yourself, talking to your accountant about what they need from you as the company's bookkeeper will help you to do your job properly. A rule of thumb when organizing your books is by dividing it into 5 categories: assets, liabilities, income, expenses, and equity. Assets are what the company owns. There are 2 main types of assets: current and non-current assets. Current assets are possessions that can be easily converted to cash. This includes cash, cash equivalents, and accounts receivables. Non-current assets, also known as fixed assets, are possessions that cannot be easily converted into cash. This can include land, buildings, equipment, and trademarks. Liabilities are what the company owes. There are 3 types of liabilities: current, non-current, and contingent. Current liabilities are short-term debts that need to be paid annually. Some examples include accounts payable, interest payable, and accrued expenses. Non-current or long-term liabilities are debts that play a vital role in the company's long-term financing. This includes bonds payable, mortgage payable, and capital leases. Contingent liabilities are debts from an unexpected outcome of a future event. This includes lawsuits and product warranties. Equities are the values of shares issued by a company. It's the investment of the business owner and other investors in the firm. The three basic types of equities are common stock, preferred shares, and warrants. Common stocks represent ownership in the corporation. Preferred shares are stocks with a set dividend that are paid out to stockholders. Warrants are mediums to buy a particular stock. Using these categories, we'll cover what the company owns and owes, as well as all the money going in and out of the business. By dividing your books like this, you and your accountant will be able to find the appropriate documents in record time. 3. Reconcile your books regularly. Discuss with your accountant on how frequently you should close and reconcile your books. An accounting period can be a month, a quarter, or a year, depending on what works best for your business. After each accounting period, a series of bookkeeping tasks should need to be completed before proceeding to the next period. One of these tasks involves reconciliation. Reconciliation is a process of comparing two records to see if it's correct and in agreement. In other words, you can check if the company's financial records match your books. Reconciliation is a fundamental step in determining how the money flows in the company. Regular reconciliation of your books prevents you from having trouble in filing taxes. In summary, bookkeeping is the organization of your company's finances. Having a regular, thorough analysis of your books is the key to great bookkeeping. Bookkeeping gives you a clear picture of what's inside and helps you determine how much money really comes in and goes out. One way to assess if you have great bookkeeping is by asking yourself, can I track the company's money right now, down to the last cent? If your answer is a resounding yes, then no doubt that your efforts will be a huge asset for you. Your accountant, and most importantly, the company's financial health,